Welcome to Advisory Insights Podcast, brought to you by Oberman Law Firm, a leading law firm serving clients across multiple industries and sectors on a local, regional, and national basis. And now, here's your host, Stuart Oberman.
Well, welcome everyone. This is Stuart Oberman here, your host, Oberman Law Firm Podcast. And today, if you're a business owner, have I got the guest for you. My special guest today is Mathew Abraham, and he is with Clifton, Larson, and Allen. And it would take me 5 years to outline his credentials. But the key thing is that he is the leader for CLA regarding their federal tax strategies. And folks, that's all you need to know. Tax savings, tax strategies. And I know he's done a lot of research and development regarding tax credits. I know he works very, very, very heavy in the tax area for corporations, small business. I know he's very, very familiar with the section beloved 199 deductions. But a while back, I had the pleasure of having lunch with Mathew, and we were talking about what he does and the resources he has at Clifton, Larson, and Allen, and talking about businesses. And the topic came up of cost segregation. And we all hear about these wonderful, wonderful areas. What is it? How does it affect? Well, I know from our firm, Oberman Law Firm, we have a lot of business owners, a lot. And I know that the land they are utilizing, that they either rent out, whether they have, they use themselves, they're leaving money on the table. So that's why I think it's so important that we have Mathew here today to really walk through some of these areas. And we're going to, cover like 4 or 5 topics, very top of mind issues, enough to let you know you're leaving money on the table. Mathew, welcome, my friend, and it is great to have you on the podcast today. And I can't wait to hear some of this information. I'm doing my research, and I can't wait to hear all this. So thank you, my friend, for coming on today.
Yeah, thank you very much, Stuart. Appreciate the opportunity. It's funny, we were talking at lunch a couple months ago, and then I know we tried to schedule this podcast, and I didn't realize when I committed it was going to be Cinco de Mayo. I should have had margaritas and tacos, instead of that here for this occasion. But you know what? Maybe today's topic is talking about tacos and tax.
Hey, well, this is a celebrated topic, no doubt about it, right? Anytime business owners who own land, buildings, whatever, when they can save money, it is a toast of the day, right? So,
Absolutely.
Everyone hears about cost segregation, but I want to drill it down. What is cost segregation? What's a cost segregation study? What is that?
Sure. A cost segregation study is basically an IRS-approved tax strategy that allows owners of commercial real estate or residential real estate to accelerate depreciation deductions. So just to back up a little bit for people just not understanding the tax world and depreciation, when you purchase an asset, you're allowed to depreciate, and that's through cost recovery. And so the traditional rules of if someone buys, real estate, whether it be commercial or residential, you're allowed to depreciate that commercial over 39 years straight line, or if it's residential real estate, 27 and a half years. So you're like, great, I'm recovering my cost. Well, if you really look at it, that you can probably find a way to accelerate those deductions. And that's where a cost segregation study comes in. It basically identifies and reclassifies certain parts of the property into shorter life categories, typically 5, 7, or 15 years. So in my examples, let's say you have $1 million tax basis for commercial real estate, and you depreciate that over straight line over 39 years. You can see it's a small amount of depreciation every year. But what if you take that $1 million and say, like, you know what, $300,000 is short life property, and say 300,000 is, call it 5-year property. You can see you're deducting 300,000 over 5 years as opposed to getting it hung up over 39 years. So it's really a time value of money play because you're basically getting the depreciation upfront, which is really going to be beneficial.
Now, this is you and I talked a little bit before we came live, And this is the IRS is not going to knock on your door and say, by the way, you're leaving money on the table. And also, I think a lot of CPAs don't maximize this. Am I correct on that?
Yeah, and that's it's we're fortunate here at CLA. We've got the breadth of services. I'm part of a specialty tax group, so I work with folks who are just doing the tax compliance for our clients. And most CPAs, if they don't understand these rules, they're just doing the tax compliance and says, okay, John, you bought this commercial real estate. It's $2 million in basis. I'm going to file a Form 4562, which is the form to put the depreciation on, and just take, the normal depreciation, right? But at the end of the day, if they really understand these rules, they're like, hey, you know what? I should do a cost segregation study, componentize this $2 million, and accelerate the tax depreciation. And yeah, at the end of the day, if you're not doing this, you're leaving money on the table. And to your point, Stuart, the IRS is never going to come knocking on your door saying, hey, by the way, there's all this tax planning that you don't have to pay us as much money. Sure. But the moment you pay $1 less in tax, you're going to get IRS notice.
You get that letter. You owe $6, and it costs them $27 to send it out, right?
Exactly. And
So
they'll send you something in the mail. And then after that, you can't respond in email. It's going to be always through fax. So it's very antiquated.
I love it. I love it. So essentially, cost segregation is basically depreciation on steroids. That's which is great. And so, what kind? Right. So we got building owners, right? So what kind of building owners can benefit from this? Is it small, large? What are some of the those who are listening to this? Outline some of the areas that the buildings that they can they can apply to.
Yeah, it's the whole host in terms of when we look at industries, right? You could be in manufacturing, you could be in technology, you could be in healthcare, medical, you could be a retail operator, any person or entity that purchase commercial real estate and then also residential real estate. So if you have a multifamily apartment building or it's mixed use, you got retail and multifamily, they all can take advantage. I think I mentioned earlier, you've got commercial real estate, those buildings over 39 years, and residential for 27 and a half years. So I'm actually working with a client right now that, fortunately, we do a lot of partnership with small CPAs, but they don't have the capability. I've got a good network and basically said, hey, can you help one of my clients? They've purchased strip malls. And so that strip mall, I think the basis was on this one was like about $3.5 million, and basically says, hey, can you do a cost segregation study? Because at the end of the day, we know we shouldn't be depreciating this. My CPA told me we shouldn't be depreciating this over 39 years. So it's the gamut of industries. Even office buildings, you can go there. Now, keep in mind, office buildings is going to be more true building aspects of it as opposed to, say, a manufacturing plant. And we talk about accelerated depreciation because certain parts of a building structure, like HVAC, you're going to need HVAC for whether it be a medical building or whether it be an office building. But if you have a special purpose manufacturing facility and you have dedicated HVAC because you have, maybe say, a server room, right? And you need this dedicated cooling, that can be 5-year property as opposed to 39-year like a traditional HVAC. So it's pretty much beneficial for any industry, commercial or residential.
Well, here's an example. So here I am, right? I'm John Q, business owner, and I have maybe professional services practice, whatever it is, whether it's investments, whether it's 2,500, 3,500 square feet, small, right? Half a million, $1 million, building, and land is obviously worth more than the timber, right?
Mm-hmm.
So let's say I own that small building. I'm maybe my revenue per year is like 1 or 2 million, right? I'm not a big guy, so can I say, hey, I want to get a cost segregation study, even though I have this 2,500 or 3,500 or 5,000 square foot little house on the corner somewhere.
Yeah, and that's a great question. And want to introduce the concept of bonus depreciation. So, if you look back to 2001, the 9/11 tax, Congress basically instituted bonus depreciation because they were worried for the economy to get ramped back up because everybody was kind of in a flux of like, hey, where is this headed? And so they passed a bill basically saying, hey, if you do CapEx, capital investment, and it meets certain criteria, you can get 100% bonus depreciation. So once you place it into service, that asset, you get 100% deduction right up front, as opposed to, traditionally bleeding over 39 years. And if you even do some of this cost seg, 5, 7, 10 years. So they're like, oh, this is fantastic. Well, that eventually sunset, and then back in the first Trump administration, they reintroduced bonus depreciation. And bonus depreciation also eventually, with that law, was going to get phased out, which it did. And then in this current administration, they passed tax reform again in July of last year. It was signed back into law. They made it permanent bonus depreciation. So there's certain components when you are going to do a cost segregation study, you can claim 100% bonus depreciation. And the reason I say this, Stuart, is to your question, if I have something small, should I be doing a cost segregation study? Well, prior to the rules of favorable bonus, 100% bonus depreciation, it was probably not as cost beneficial. But now with 100% bonus depreciation, even some smaller, size property, you should be able to, pursue down this route. And that's one thing, our firm, we're always willing to have a conversation just to kick the tires to say, hey, is the juice worth the squeeze? We can do some modeling and say, hey, you know what, based on what you have, here's what we're anticipating in terms of deductions, and here's how much it would cost, i.e. our fees, our time, our effort to do it. So I think because now bonus is 100% bonus is back in as a permanent part of the tax law, everybody should be looking at it no matter what the size is.
So if I'm a small hotel owner, perfect. If let's say I'm a healthcare provider, and whether I'm a dentist, veterinarian, optometrist, I have an office condo that I maybe lease out for rental properties, or let's say I'm a potential hospital or other medical building. Those are perfect scenarios for cost segregations.
Absolutely. And if you look, Stuart, with respect to the medical field, a lot of these, build outs, they're going to be highly technical rooms dedicated for like, OR, especially like when you look at a hospital, even outpatient centers, there's going to be certain stuff in that building that should be classified as short life property. So at the end of the day, I have never, in the 25 years been doing this, not had a good conversation with somebody with running a medical practice that hasn't done a cost segregation. Without
Wow.
a doubt, there's always going to be savings with respect to that. Now, I think I mentioned earlier, like the office building is less because it's a traditional building. If that tenant left and then another tenant moved in, well, you don't have to do the HVAC, you don't have to redo the electrical. But if a new tenant come in there and they were a physician's practice and it was a retail location before, there's going to be a significant build out to get it into the state that it needs to do its business in the medical field. So, they are
So
prime candidates with
So
respect to
here
cost.
I purchased a building, or let's say maybe I've already had a building, maybe for 3 to 4 years or 5 years, um, or maybe 5 years, right? I'm listening to our podcast. How does it work, and is it too late, or can anyone sort of join in? And what's that time limit? Because then we have some people thinking to themselves, guys, I've owned this building for 5 years. I can't do that. So what are those time periods? How does this work?
Yeah. So if you look at a cost seg study, you kind of look at it, and if you really break it down, it's really 6 steps. You got to identify the property and the depreciable basis. So you're like, okay, I got this medical building, it's 3.5 million. Then you got to collect all the information and the property data associated with that. Then you have to perform more of an engineer-based analysis. It can't be based on estimates. You have to classify the components into modified cost accelerated recovery system, its makers. Then you reconcile the totals to the actual documentation to say, okay, I got 3.5 million, all these invoices add up. And then finally you implement it on the tax return. So you kind of have to walk through those detailed steps to do an actual cost seg study, and implementing on the return is key. Now, your question was, hey, if a few years pass, am I kind of blocked out? Well, the beauty of this is the IRS allows you to go back in time and say you built, purchased that building or constructed that building 5 years ago. You haven't lost on the deductions. You have depreciated on what was traditionally given to you, say it was commercial real estate, 39 years. So you've been claiming the depreciation. But let's just say that $3.5 million of basis, if you were done a cost seg 5 years ago, it should have been like 1.5 million of accumulated depreciation, but you only have 500. Well, you can go back and recapture that $1 million of missed deductions in those prior years. And what the government does here is you don't have to file amended returns, which is fantastic news to a lot of small business owners.
That's
and the
great.
reason
Yeah.
I say that,
Yeah. Yeah.
you've got a lot of entities which are S corporations or partnerships, LLCs, and they're flow-through entities. So their business owners are getting a Schedule K1. So anytime you take a benefit or you record income on the entity level, that passes through on a K1 and you put it on your individual return. So say you go back 5 years and you've done this, but you didn't do a cost seg study. To take advantage of this without what I'm going to talk about, you would have to file amended returns for the entity as well as the individual owners. So say you have a physician's practice and you have 15 doctors, all partners. That means traditionally to get this deduction, you'd have to amend that tax return from 5 years ago and get amended Schedule K1s for all the partners. And they would
it's
have
a mess.
Yeah, exactly. So the beauty here is you can file what's called a Form 3115, an application for change in accounting method. And the beauty of that is you can go back in time, do the cost segregation study as you were doing it today, but you still have to apply the tax rules that were applicable in those years. So say 5 years ago, bonus depreciation was 40% of eligible assets. You'd apply that tax law, and then you'd calculate what was quote unquote missed depreciation and put that on the current year return with attaching a Form 3115 and application for change in accounting method. So you might have lost a little time value of money, right? Because you didn't take advantage of it 5 years ago, but by no means you cannot take advantage of it. So if you have something that you've been operating for a few years and all of a sudden listen to this podcast, you're like, hey, I got money on the table. Have a conversation with your CPA, see if it's a service that they provide or find someone who can provide it, because at the end of the day, the clock is ticking. And the longer you wait on it, and let's just say you wait 39 years, then there's no benefit. Already depreciated, right?
We're probably dead by then, right?
Exactly. You might have sold it, so.
Dude, I mean, take from this perspective, right? I'm a business owner and I'm like, oh my God, look, I'm already working 12, 15 hours a day. I don't have time for all this. Is this something like they come to you and say, hey, Mathew, I want to do this, and you guys sort of walk them through that process? Because I mean, it could be overwhelming for a guy that's working, 10, 15 hours a day.
Yeah, absolutely. And, I feel fortunate in my world, and, I'm not going to knock my fellow colleagues who are auditors, but no one, whether, you're an external auditor or internal auditor, is revered because you're sitting there and you're sitting in a room and basically always asking for information. My wife's an accountant and she deals with auditors, and she's like, from January through March, she knows in addition to her full-time job, she's asking questions. Where from a consulting perspective, we do these projects is very minimal time commitment from a client. We'll ask for a lot of information up front, and this is already stuff that you would have. Like, for example, if you acquired this building, we'd ask for the purchase and the closing documents. If you constructed this building, we would ask for the construction and renovation cost detail. Usually that's something called an AIA, application for architecture statement, and that's something. If it's new construction, we'd ask for blueprints. If it's already in place, fixed asset schedules. So we can look through all that data and start doing our analysis. So ultimately, once, if you're a business owner, you might have somebody who's your accountant in-house. They can get us this information. And then ultimately what we'll do is a site visit. So it doesn't involve one of the physicians. If we're talking about a medical practice, it might be the office manager. and we would just do a physical inspection of the commercial property or residential, whatever it may be, to kind of say, hey, okay, we've actually looked at it with our own eyes, as opposed to saying, hey, we got some arbitrary property that we're claiming these tax deductions. So to answer your question, Stuart, we try to make this as painless as possible from a client's perspective. And, time in and time out, it's pretty seamless for our clients as long as we can get the information, and we'll work to their timeline. We like to do these well ahead of when a tax return needs to be filed, so you're not scrambling. And if you do these early in the year, we can work with your tax provider to tell them, hey, here's how much benefit they're going to get, and you can reduce your estimated tax payments. So you can manage your cash flow before the due date of the return. A lot of times, if you don't do these, you're overpaying your estimated tax payments on a quarterly basis, and then you might have an overpayment which you could supply next year. But hey, I don't know about you, Stuart, but I'm not in the business of giving the government a free loan, right? And that's what you're doing if you're not properly taking advantage of things.
Here's the wonderful thing, right? Oh my gosh, the IRS. Everyone loves the IRS, right? So what are the flags? I know the IRS lists, I don't know, maybe 10 or 15 or 13, whatever items that, hey, these are flags. What are some of the flags that you got to watch out for that people want to get really massively aggressive on?
Yeah, that's a great question. And, in this day and age, you want to make sure that you're not doing anything by the seat of your pants. We've worked and seen boutique firms, especially in the R&D world. I know you mentioned that some of my background, they're just taking frivolous positions or not substantiating, things. And same thing with the cost seg study. You want to make sure, the IRS is not really questioning whether you're doing a cost seg study, right? Basically, they want you to do a cost seg study, but they want you to make sure that you're doing it appropriately. And what that means is, how is the study prepared? Is it properly documented and implemented? That's the key when it looks at the IRS. They want to see, call it an engineering-based cost seg study. They want you actually looking at the detail, doing what's called takeoffs, basically looking at blueprints if it's new construction. They want you to do a physical inspection. Common compliance failures are spreadsheet only, cost seg study. They're like, okay, we'll put together, or say rule of thumb, I know you're a retailer, and traditionally we say 30% of it's going to be short life property. And then what I've also noticed, some providers don't look at land truly for what land costs, because unfortunately land is not a depreciable item.
Yeah.
And then, if you have to allocate a certain portion, let's call it 10% of a $1 million property, let's just say for simple math, that it's in the rural part of the state, you might say 10% is still land. But obviously, if you have a medical facility in Midtown Manhattan, that land value is going to be pretty pricey. And so you need to say, okay, you know what, 40% really goes to land. Now you have 60% to work with. So it's things like that that could really draw scrutiny from the IRS. I mean, I always tell business owners that when you look at doing a cost seg study, basically make sure it's engineering based with site inspection, component level documentations, good citation of the tax law, conservative, defensive classifications. You can't tell me in a building that's not really dedicated for like a server room that you have an HVAC that you can depreciate over 5 years. That's 39-year property. You want to have a full basis reconciliation. So all your cost accounting says, okay, this is what's on my trial balance. Here's the true basis of the property. It lines up. If you're, doing a back year study, a look back, as you mentioned, if you hadn't done it in real time, a proper completion of the application of changing the accounting method for 3115, then put it on the tax return. You could do all this great work, but if you don't put it on the tax return, then you really haven't done anything, right? Yeah. And sometimes You will have to be
Document, document, document.
correct. Exactly. And the last thing I
Wow.
would say, clear audit trail. So in the event this gets challenged, we like to do a pretty robust project here from a CLA perspective. We'll do a quantification. Get all the costs. We'll get you, and we'll also do a full report with basically do the right citation of the tax code, any case law. It basically says, okay, this is all the property, and this is why you can qualify. As I said earlier, the IRS does not, say you shouldn't do an R&D study. I'm sorry, a cost X study. They want you to make sure that you're doing it copacetic.
Yep. Oh my gosh. Wow. I mean, I'm taking notes as you're speaking. There's so much information here. Wow. That's a lot of ground. That's a lot of ground. And it's the great information was one, if you have a business and you own a building, small or big, get a cost segregation study. Two, if you have a building, even if you've had it for a couple of years, take a look at it. You may still be eligible. Document what you're doing. Have the experts like yourself walk them through the process. Have that audit trail. And again, why wait for 39 years when by that time the business owner could be dead, right?
Yep,
And the other alternative that you said, is cash flow. It improves cash flow, which is
absolutely,
unbelievable. Unbelievable.
exactly. And in
Wow.
this date, we've gone away from the COVID levels of interest rates being so low, right? If you're a business owner, you have to go out there. The cost of capital has gone up much more than it was in 22 and 2023. Why not find tax deductions and generate the
Yeah.
internal cash flow to reinvest in your business, right?
Yep.
So, like I said, this is a great planning tool. Um, sometimes people are like, oh, I'm worried about the IRS, and kind of walk through like, if you do everything
Yeah.
by the books, then you shouldn't have anything to worry about. And if you get a credible provider to do this, it's something that you can do in lockstep with them. And if your CPA firm does not do this, partner up with somebody, because it's one of the things that when I talk to small CPA shops, I'm like, hey, I'm here to just add value to your client, help them, because it's something
Yeah.
that as a service provider, the ultimate responsibility is to do the best work for our clients, right? So if
Yep.
you can't do it, find someone who can do it. And then, if you're a business owner, listen to this, have that conversation with your CPA. And 99% of providers out there will do this, at a no risk obligation. You just need to provide them with some data. They can scope it, we can scope it, and provide you with a benefit estimate. And if the juice is
Yeah.
worth the squeeze, you move forward. If it's not, a little bit of
Yeah.
time. But at the end of the day, if it's going to be tax savings, it's well worth the time.
Tax savings is always well worth it, right? Wow.
Absolutely.
Matthew, amazing information. I know I could take so many notes and preparing for the podcast. I'm like, wow, there's so much out there that small and big clients are not even aware of. So I know, well, you opened up my eyes. I know that those people listening, you've opened up their eyes. So, any last words before we call it a day? And amazing information. I can't thank you enough.
Yeah, I mean, last words are basically there's always tax planning out there available. And sometimes, depending on who it is, they just don't have the sophistication to understand this. So if you're working with a small shop, CPA, I'm sure they're doing a great job with your tax return, but you have to press them and to say, like, hey, are there things that I'm not taking advantage from a business perspective that I should be? Because as I mentioned at the beginning of the podcast, the government is never going to come to you and say, hey, you have to take an exam.
Yeah. Oh, by the
So
way, here's some more money, guys.
exactly. So we know
Everyone's
our
like,
friends
hey,
at
hey,
the
hey,
IRS.
versus like, here we go.
Absolutely. Yeah.
Wow.
So
That's
my
great.
last words is just basically have the conversation with your CPA. Reach out to us if don't have somebody who can help you with this. We'll be happy to have that conversation with you. And it's just an exercise to say, like, hey, kick the tires to make sure that you are maximizing the tax law and paying as little as amount of
Wow.
tax within the confines of the tax law.
Wow. My friend, great information. Thank you so much for joining us. You guys do a fantastic job. Clifton Larson Allen, amazing guys, a lot of resources, and I know you're an expert at what you do. So thank you for your time.
Yeah, I greatly appreciate it, Stuart. Thank you so much.